Let's talk money.
Hello and welcome to another edition of Let's Talk Money with me, Surabhi Updhahyay. Now, we always pay plenty of importance to the equity part of our portfolio, the right stocks to own, the right funds that we must have. But do we pay enough attention to the fixed income or the debt side of things? Perhaps not. Many of us are perhaps quite happy with our fixed deposits and we leave it at that. Pretty much that's that. But is there a need to rethink our debt investment strategy? Should we be moving beyond FDs? And if yes, what sort of debt funds and even direct bond investments perhaps make sense in the present market environment? Well, that's the topic on the show today. And to discuss this and to answer all of your questions, I have with me Vishal Goenka of IndiaBonds.com and Mohit of Moneyfront. Gentlemen, thank you so much. Great to have you in our studios on a topic that I confess is not discussed perhaps as much as equities. But it really got me thinking when we were thinking about having a conversation on fixed income, that perhaps it requires a deeper thought. Mohit, why don't you go first? I know we've had umpteen number of equity mutual fund conversations, but what are clients telling you? Is there an evolution happening towards making your debt portfolio?
Look, to be very honest, Surabhi, I think it's been a while that I have had clients proactively coming back and asking for fixed income options. The run-up in the equity markets is so crazy that obviously people have kind of kept it at the back burner. Though as advisors, we make a very conscious effort to keep reiterating the fact that asset allocation is the most crucial component of the entire portfolio. And perhaps fixed income deserves a lot of merit, and more so right now, in the way the yields are and where we are positioned in terms of the rate cycle and perhaps the inclusion of India into the JP Morgan bond index and Bloomberg index, so on and so forth. So a lot of action is going to happen on the bond side. And I think, genuinely, people should pay attention to the fixed income part of it.
Absolutely. And I'm glad you brought this up because if the foreigners are going to come in and buy our bonds, and as Indians, why shouldn't we own more of them, right? So that's a great point. Vishal, as we get started, let me tell our viewers that, of course, India Bonds is one of those platforms where you can actually go and directly buy bonds right now. And that's not a marketing statement I'm making. It's just for information. But Vishal, as someone who's watching this market sort of grow and evolve, do you really see a lot of takers, at least at the retail level, people who generally want to go and buy a bond for their portfolio?
No, I think the educational awareness or the financial education awareness in this country has really gone up. So people do realize they need to diversify their portfolio. If I have 1 lakh or 10 lakhs or 1 crore, I cannot put everything in equity markets. People did not have access before this. They did not know where to go, where's the information, what is an information memorandum, credit rating. So I think that dramatic change is happening thankfully to the SEBI regulation around online bond platforms. So we do see people are buying 10,000 rupees of bonds, people buying 1 lakh, 10 lakh on a platform even to up to 1 crore. So the fact that you can actually invest in bonds directly has been a changing scenario for people's portfolio.
Oh, absolutely. So, gentlemen, I want to really, make the most of this classroom and start with very basic grassroots level concepts that we should bear in mind whenever we're thinking fixed income, right? By nature, whether you're investing in a debt fund or a bond directly, or even a Government of India security, essentially you're buying a security where, someone is offering the promise to give you the money back. That's essentially what debt is all about. So, Mohit, let's start with the concepts. As fixed income investors, what is it that we should be aware of?
Okay, look, I think first things first, for a fixed income investor, it's absolutely essential to know that there are 3 ways of making money in the fixed income market. One is accrual, which is the coupon or the running yield of the paper which he's buying or the bond he's buying or the fund he's buying. The second is credit, which is what quality of paper is he buying. Is he buying the AAA paper, the AA, the single A, or perhaps going down the ladder and buying a riskier paper? And that's what's the spread between the AAA and the single A paper? And what's the differential between the government and the corporate paper, right? So that's the credit play. And third is the duration, which is what is the kind of tenor of security he's buying. Is he buying a 6-month paper, 1-year paper, 2-year paper? Or he's going for the long tenor, which is 10-year, 20-year Government of India bonds, right? And a mix and match of all these 3 strategies, which is playing the accrual, playing the credit, and playing the duration, is the fixed income game. Sounds complex, but
this already is sounding really, and I'm sure for the first time people out there. So Vishal, the onus is on you. Now simplify that even further. The concept of accrual, the concept of credit, and the concept of duration.
So as you said, what is a bond? A bond is you have lent money to somebody who gives you a rate of interest in exchange of that, and a promise to return your money after a certain period of time. So accrual is nothing. Accrual is the fact that you're earning interest on the loan or the money that you've given to somebody. The duration is obviously what is your investment objective? Do you need money invest for 1 year, 3 year, 5 year? Talking on Mohit's point, the longer you invest for, more risky your asset is. So one aspect, which is the risk to keep in mind, is interest rate risk.
Absolutely.
If absolute interest rates go lower, which is what India is looking at right now, you can actually also make capital appreciation on your bonds, right? So, to his point, accrual is important, duration is important, and of course the credit risk.
Yeah.
If you give money to the government of India, it is the safest, it's called risk-free. But if you're giving money to a public sector or a bank or a state
private
guarantee
entity.
or private entity, so the risk metric, which is judged by credit ratings from AAA, AA, single A, you get higher returns for taking more risk.
Absolutely. So just keep these concepts in mind because we will come back and we'll revisit them. We'll give you more details on them. And also we need to bear in mind, Vishal just mentioned that as interest rates start going down, you could get capital appreciation. And that's, again, I'm just reiterating a very fundamental principle. There's, as rates fall, typically bond prices rise. And that rise in prices is what leads to a capital gain, which is possible in fixed income. More on this as we go along. But let's also get some of the viewer questions in. We have Rajesh with us on the phone line. Rajesh, welcome to Let's Talk Money. Tell us, what's your question?
Hi, this is Rajesh. I'm 59 years old and I have most of my investments in equity and gold. I would like to diversify into debt and fixed income in order to have a steady income for my retirement years. Where should I start? I have some investment in public provident fund already.
Okay, great, Rajesh. Thank you so much for joining us on the show. And I think your query is the query of the nation. Maybe I can say that because a lot of us already have investments in either fixed deposits or some of these, small saving schemes or the employee provident fund.
Right.
The question is there a need to now think beyond that? Mohit?
Oh, totally. Totally. Like, I think one has to go beyond the PFs and the normal PPFs and the Sukanya Samriddhis and the NSEs of the world. Though I understand NSEs and KVPs are out of equation now. But even the other instruments, look, I understand they give you tax-free returns, which is a massive, massive thing in the world of debt. When you're getting 7.1% on your PPF and you're getting 8.25 on your PF, I think that's a fantastic
And
return.
those are the only two ones which will not tax you even when you're withdrawing the money at
Even
the end
Sukanya
of it.
Samriddhi.
Even
8.2,
Sukanya Samriddhi.
even Sukanya Samriddhi at 8.2, I think these are fantastic instruments.
So you would, advise putting aside some money in
Always,
these?
always.
Okay.
Just let your PF corpuses go on. Just continue the PPF. Though the shortcoming out there is you can only put in 1.5 lakhs every year. But I think these are fantastic instruments which all of us should do. But beyond that, to create a sustainable fixed income portfolio, one has to start considering mutual funds as a very, very strong option out here, right? And under mutual funds, you have all the options on your plate. You have the short-term funds, you have the medium-term funds, and you have the long-term funds. Just to simplify the entire thing, if you really want to park it for a very short tenor, don't want to take any chances with your money, want to keep it safe and secure, then you go into the short end, which is the liquid, the money markets, the ultra shorts, and the low duration funds, this category. You want to run a mix and match strategy where you take some amount of credit and some amount of duration in your portfolio, but don't want to overly risk your portfolio, then you get into the medium-term zone. And if you really want to play the interest rate cycle, which I think Vishal was also referring, that as we foresee an interest rate cycle reversing from here on, perhaps 6 months down the line or a year down the line, then going into the long end of the curve, which is going into the gilt funds or the long duration funds or the target maturity funds, is a fantastic option right now. So investors will have to start considering that. And once you are done with this allocation, that's the time when you start saying, okay, now I'm savvy enough in the world of fixed income and perhaps I can look at some other instruments, and then enters the world of directly investing into bonds or maybe some securities and so on and so forth.
Okay, so those are, the steps that you would advise.
Yeah.
Go with small saving schemes which give you the tax advantage, like the EPF or the PPF. Look at certain debt funds and then venture out into direct bond investing as well.
Totally.
Got that. Just contrast the two, because the other fact of life, Vishal, is that a lot of retail investors also want to try things on their own.
Yes.
Maybe they're very eager, especially maybe youngsters are very eager to jump the curve that our friend Mohit just pointed out here. Now, should one even consider that, or could that get really risky if you start buying bonds directly?
No, absolutely not. So firstly, I want to congratulate Rajesh. At 19 years, he's thinking about regular income for retirement. So that's fantastic.
At 59.
Okay. And thank you. I think you can ideally start with government securities or AAA rated or public sector bonds. So you take away a large factor of credit risk is what takes people time to understand. And I think in this world of do it yourself, you should absolutely go buy a bond directly. You know, the coupon starts coming into your bank account. It adds to your income. You see how it plays out for a year or two. And once you understand, read more about it, the information memorandum, what do rating reports look like, you invest in your own education at a very early stage. But then I would advise starting with government securities and AAA rated bonds, and then slightly move into more riskier assets.
So when, again, to simplify for our viewers, when Vishal is saying that there's lesser credit risk in government securities, government bonds, that basically means a lesser chance of defaulting. Credit risk, in very simple terms, is equal to the chance of the bond issuer defaulting. And well, in government securities, it is the sovereign, it's the government of India backing that bond. So, I mean, absolutely almost nil chances, zero chances of any default happening. You know, gentlemen, we do have to take a break, but then I want to dive further, you know, deeper into this whole conversation about direct bonds and how and why not. We'll take that break, come back, and we will answer more of your questions on the other side.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week on the show we're discussing why perhaps there's a need to go beyond lazy fixed income investing in the form of fixed deposits, why debt mutual funds and perhaps even direct bonds are worth your while. We have a viewer query coming in. Akansha is with us on the phone line now. Hi Akansha, welcome to Let's Talk Money. What's your question?
Hello, I'm Akansha. I want to invest in fixed income securities directly. How does one know how safe a bond is given the fact that frauds have happened earlier despite good credit ratings?
Akansha, thank you for asking that question. You've really taken it, you know, from me literally. And it's very heartening to know that there is that awareness, because we've had episodes and not too recent, you know, not too old a past, frankly, which kind of come to mind. So, you know, gentlemen, let's start by, you know, understanding how to evaluate. Like you said, I mean, if it's the government of India, we're fine. I mean, that's secure paper. But if it is, whether it's state governments, whether it's corporate enterprises, PSUs, how do we know that what is AAA indeed can let us sleep peacefully at night? Mohit.
Look, honestly, I think there are no easy answers to this one, right? By default, credit rating is something which you will all want to watch out for. It's the gospel of truth for the bond market. A AAA is obviously the most secured. You have sovereign, which is the government of India, and then you have AAA papers, which are perhaps more often than not, those are the ones which are backed by government of India, which is like the RECs, the NHIs, the PFCs of the world, right? And then you have AA plus, AA minus, and the ladder goes down to BBB plus, which is the last point of investment grade bonds available in the country, right? I think now, look, one has to look at with what credit rating agency is giving this rating. There are multiple agencies in the country. But once you have the stamp from a CRISIL or an ICRA, you have a little more confidence that the credit rating has been done by a reasonable agency. You can't just stop at credit rating. We have instances, and as Akansha rightly pointed out, we have had instances of cases like Ireland FS and look, SR and ADAG groups and multiple.
In many cases, they were AA or AAA rated entities, these entities.
Absolutely. These were all AA plus kind of entities, Ireland FS, DHFL and all those kind of things, right? So instances have happened, and an investor will have to be extremely aware of the fundamental strength of the company, the quality of the promoters out here, who are the other investors in the company. Does the company have some stakeholders who are institutes in nature, right? So all those kind of enhances the governance part of this. Just the credit rating is not enough. What has been the past track record of the company? And whenever you see crazy yields, which is anything going above 10%, there has to be an alarm bell sounding in your mind.
This, I think we should really play on loop again and again, and Vishal, comment on this, because, you know, this is the lure. For investors, the lure is my fixed deposit is giving me 7%. Here is a bond that's giving me 9%, or in some cases 10%. And that's where mistakes may happen in terms of investors doing their own due diligence. How do we guard against that?
So I will answer Akansha's question first. just because, you know, in India, we had a massive credit upheaval since 2017, 18, 19. And yes, we did have some mishaps of companies defaulting. It is absolutely natural to happen in any global cycle. In GFC in 2008, we had AAA securities go defaulted in the US and the Western world. So I think we should just stop beating ourselves about it, because the country has actually gone through an education cycle. Smart questions like this are telling me that people, thanks to technology and maybe, you know, COVID-enabled kind of self-learning, that people are reading more about it, are more aware of the risk associated. So when you're judging a company, I think, as Mohit pointed out, you know, there's a lot of material you can read, which wasn't the case 2-3 years ago. You can read the information memorandum. You can actually read the credit ratings report, which I don't know was very easily accessible 2 to 3 years ago. So I think we should let the ghosts of the past lie, learn from our mistakes. You know, equity markets, stocks go up and down 25-30%. People don't stop investing in equity, but learn from it. Yeah. And I think I would encourage that in fixed income as well. And so credit ratings is an important stopper, but learn about the industry, about the company a little more, will help you to choose the right issuer.
I remember doing shows at that point in time titled "Is Fixed Income Really Fixed Income?" Right? Because that's what really happened back then. So awareness is really important, and the onus lies on us as investors. Yes. But having said that, let's now move forward and talk about sort of if at all you're looking at direct bond investing, if you have the risk appetite, then how does one do it, Vishal? So I mean, how do you go about it? What's the KYC process? And more importantly, what about regulation? No. Who regulates this? Where do the securities lie? Tell us all.
I think there's been a dramatic change in India last year and a half. So online bond platforms are regulated by SEBI in this country. So the first and foremost thing when you are doing direct bond investments, make sure that the platform that you're trading with is regulated, which means it's a stockbroker and licensed. I think that is very important. Once you become a stockbroker, all the other compliances fall into place in terms of scores, redressal mechanism, you know, a grievance mechanism, etc. So that's the first check people should make about direct bond investments. Secondly, only OBPs can only show listed bonds. Now, what is the difference between
OBP, online bond platform.
Sorry about the jargon. Can only show listed bonds. Now, what is the difference between listed and unlisted bonds? Listed bonds on the exchange have a requirement to report regular financial earnings and disclosures, which unlisted don't. So people should be very careful and ask the question, is this bond unlisted? The third thing, I think fixed income, people are still learning, and there are a lot of fixed income type of securities that are being offered on platforms. So be aware of, you know, structured debt, be aware of, you know, a lot more complex debt before you're investing. But investing online, OBP, online bond platform, SEBI registered, you have a regulator overlooking that and gives you the safety, much like equity investing.
Well, fair enough. Ask enough questions and don't invest if you don't understand the product. That's the simplest rule of personal finance or wealth management. Okay, we have a question coming in from Villa, and we've got this question on Instagram. Villa is saying, what is the best debt fund available in the market right now? And is there any chance that the favorable taxation regime for debt funds may come back? Well, we wish we knew, Villa. We wish we knew what's going on in the minds of the finance minister, but we don't. But I mean, more on taxation in just a bit. But first, let's answer the question that a debt fund in the present environment. Mohit?
Look, Surabhi, I will give Villa two options out here, right? If the parking is meant for short term, which is, let's say, up to a period of 1 year to 3 years, right? Then gentleman has to be on the short end of the curve, which is have to invest in short term bonds or, let's say, low duration kind of funds. So out there, you can perhaps choose an ICICI low duration fund or a Kotak low duration fund, right? And if you are really looking at fixed income from an opportunity perspective, which is that you want to make slightly higher returns than your regular FDs and perhaps a little higher than other fixed income instruments also, and you want to play the interest rate cycle, then you have to go to longest duration with the safest instruments, which means that you have to choose a portfolio which is predominantly GSEC based or gilt based and have a very long duration. So out here,
like 7 to 10 years? Or?
I would go even beyond 10 to 12 year mod duration. Okay. So you have 2-3 funds out there in that space. You have an HDFC long-term debt fund. Okay. It's a classic portfolio. You have a Nippon Nivesh Lakshya portfolio, which is again a very good good debt fund with extremely long maturity gilts in the portfolio, or you can go long dated target maturity funds. So you will have an Edelweiss Bharat bond, perhaps 2037 or 36 series, which is again a fairly good thing. But I think the first two funds are the longest duration funds you will find in the industry currently.
So again, I mean, just explain to us, Mohit, this concept of duration, because now you are basically investing in a fund where the blended portfolio, all the securities that are there in that fund, the blended duration would be, 10 to 12 years, as you're saying, right? So is this an investment? Again, our investment period, time period is also important, right?
Yeah.
Should you get in this fund to be in it for 3 to 5 years, 1 to 3 years, 6 months? With what time horizon should a person get in?
Look, so the way to look at it is very simple. Number one, you look at the running yield of the portfolio. So let's say if I take an example of HDFC long-term debt fund today, the running yield of the portfolio will be somewhere in the range of around 7.4 to 7.5%, right? Which means this is the annual coupon which those bonds are paying to me, and I will get that as in my annual receivable every year. So which is fair and square, 7.5% I receive every year from the portfolio. Now, if the interest rate cycle reverses, the way to look at the sensitivity of this is that if interest rate cycle reverses by 1%, a typical 10-year mod duration portfolio will give you a 10% capital appreciation. It's a thumb rule.
Okay.
It's a thumb rule of judging. So if you're playing a 12-year mod duration fund, which is the case with HDFC long-term debt fund, and if the interest rate cycle tomorrow reverses by 1% over a period of, let's say, 2 years or 1.5 years, I don't know when it will reverse by that extent, 6.5 repo coming to 5.5, or the way to look at it is a 7.17 10-year GSEC coming to, let's say, 6.17 kind of a number, right? If that happens, then you have a 12% capital appreciation over and above the running yield of the portfolio.
So the yield plus a 12% capital appreciation,
Absolutely.
Basically the price of the bond moving higher because interest rates have come down.
So in 2 years, I make 7.5, which is the yearly running yield, which is 15%, and then let's say 1% reduction in the yield, I get 12% additional.
Yeah.
So I am technically making 27% roughly from a 2
Are we
to
still
2.5
talking
year
fixed income, or are we suddenly
perspective.
talking equities?
It's a 2 to 3 year kind of a window. Look, and you are basing your assumption on the rate cycle reversing and impacting the portfolio. But I'm pretty confident that this is a great strategy to play if you are willing to take some chances.
Okay, so that's lots of thought in terms of funds, and if that's the route that you're taking. Finally, Vishal, quick last word with you. Again, I'm going back to the investor who's taking his or her baby steps now, just getting away from the PPF and the EPF and the fixed deposit. Just reiterate the route and the red flags we should not ignore along the way.
No, absolutely. I think direct bond investments versus, let's say, other mutual funds, both can coexist, can give you the ability to earn higher returns, right? Because there's an intermediation cost, there's a management cost which we do away from. Investing in direct bonds is pretty simple. Make sure the platform that you go to is SEBI registered online bond platform provider. KYC on a platform like us is digital and paperless, takes 3 minutes. So you can actually invest in a direct bond in 5 minutes on an online platform. And again, it is under SEBI's regulation, so completely safe and secure. Another fact I would like to highlight, the payment you make on a bond platform, the money actually directly goes to the clearing exchange. So it's in fact one step safer than investing on equity platforms. Things to look out for, make sure there's SEBI regulation, make sure you read the information memorandum and credit rating reports, and make sure you invest in listed bonds.
Okay, gentlemen, thank you very much. I think this is pretty interesting. Lots of thoughts, lots of food for thought, actually, that we're leaving our viewers with. Hopefully, this will invigorate them to go back, talk to their financial advisors, and think whether it's about time that we move beyond the humble and very simple and sweet fixed deposit. Well, with that, we come to the end of this week's edition of Let's Talk Money. Keep sending us your feedback. We'll see you again with another theme next week. Thank you for watching.
Let's Talk Money